Welcome to the deep dive. We aim to get straight to the core of complex subjects, giving you the knowledge you need without feeling overwhelmed. Today, we're really focusing on something fundamental in finance, security analysis. You want to understand how to assess investments, thoroughly and efficiently. That's what we're here for.
That's right. And we're not talking about the whole universe of financial analysis today. We're specifically looking at security analysis proper, the nitty-gritty of evaluating individual stocks and bonds, understanding their real value and safety.
And our main guide for this is Benjamin Graham. His work is just foundational, isn't it?
Absolutely. He's really the bedrock.
You think about the societies of analysts, the textbooks, the ethical codes. So much traces back to Graham. His influence is just huge.
It really is. Graham gives us this time-tested framework. So our mission today is to pull out his core principles, his techniques for analyzing securities, especially with the non-professional investor in mind. We want to equip you with a solid understanding.
Okay, so what's the plan? We're going to break down how to analyze bonds and preferred stocks, focusing on safety, and then we'll get into the methods for valuing common stocks, trying to figure out what they're actually worth and if they make sense as a purchase.
Exactly.
All right, let's start with bonds and preferred stocks. Where do we begin?
Well, when you look at the whole field, figuring out the safety of bonds and good quality preferred stocks is probably the most dependable part of security analysis. Graham really stresses looking at the company's track record. How well have its past earnings covered the total interest payments on its bonds? You need to look at this over several years.
Okay.
And for preferred stocks, it's similar, but you look at how well earnings covered both the bond interest and the preferred dividends combined.
So the history is key. Does the company consistently earn enough to handle these fixed payments comfortably? You mentioned coverage standards earlier. Are these hard and fast rules?
That's a good question. They're more like guidelines, really, not strict laws. Graham offered some recommendations back in a 1961 textbook revision. For example, for an industrial company, he suggested average earnings over, say, 7 years should cover total interest charges at least 5 times over.
5 times, okay.
And for investment-grade preferreds, it was also 5 times coverage, but calculated slightly differently. You'd look at earnings before tax compared to bond interest plus twice the preferred dividends.
Twice. Why twice for the preferred dividends?
Because preferred dividends are paid after tax, unlike bond interest, which is tax deductible. So you need more pre-tax earnings to cover them. Makes sense.
Got it. Yeah, that makes sense. So it's about the average performance. But what about a really bad year? Does that matter?
It definitely can. While a good average is important, some analysts argue you also need to look at the coverage in the company's worst year during that period. Graham acknowledged this poorest year test. He saw it as a valid alternative, or maybe a supplement, to just relying on the average. The idea is a bond might still be reasonably safe if it meets the average target or if it shows decent coverage even in its toughest year.
Okay. Now, things have changed a bit since 1961. Interest rates, for one, have generally been higher. How does that affect these coverage ratios?
That's very relevant, yeah. Higher interest rates can naturally make it harder for companies to show those really high coverage multiples like 5 times or more. So an alternative approach came up. Look at the percentage the company earns directly on the principal amount of its debt.
Okay.
For instance, maybe an industrial company should aim to earn, say, 33% before taxes on its total debt principal.
Right.
But it's important to remember, many companies still have older bonds out there that were issued when rates were much lower, so their actual interest burden might not be as high as current rates would imply.
So earnings coverage is sort of the main pillar for judging safety, but it's not the only thing we look at for bonds and preferreds, is it?
No, definitely not. Graham pointed out several other important tests. One is just the size of the enterprise.
Size? How does that work?
Well, there's this general idea that bigger is often safer. Minimum business volume thresholds for industrials, utilities, railroads, or for municipal bonds, a minimum population size for the city or state issuing them.
Okay. What else?
Then there's the stock-Woody ratio. This compares the market value of the company's common stock, the junior equity, to the total amount of its debt.
So it's like a measure of the cushion?
Exactly. Think of it as a cushion. It reflects the market's confidence in the company's future and shows how much value could theoretically disappear before the bondholders start getting nervous. A bigger equity base means more security for debt holders.
Right. That makes sense. More skin in the game for the stockholders. What about the value of the company's actual assets? Right. Buildings, equipment, that sort of thing. Isn't that important for bond safety?
Historically, yes, asset value was a huge focus. But experience kind of taught a different lesson. For most companies, the ability to consistently generate earnings is far more critical.
Really?
Yeah, if the earnings power dries up, those physical assets often turn out to be worth much less than you thought, especially in a forced sale.
Hmm.
That said, asset values do still matter significantly in certain sectors. Public utilities are a key example because their rates are often tied to their property investments. Also, real estate companies and investment firms where assets are the core business. But for most industrials, earnings power is king.
Okay, so we're looking at all these factors: earnings, size, equity cushion, sometimes assets based on past performance. But can we really trust the past to tell us if a bond will be safe in the future? That's the big question, isn't it?
It absolutely is the fundamental question. And, looking back over decades of investment history, the answer seems to be, generally, yes. Bonds and preferred stocks that consistently met stringent safety tests based on their past performance have, by and large, proven resilient when future challenges hit.
Can you give an example?
The railroad industry is a classic case. Back in the day, the railroads that took on too much debt and didn't have strong enough earnings coverage, even in good times, they were often the ones that went bankrupt later.
Right.
But the railroads that met those conservative safety tests generally managed to stay out of major financial trouble. Even after the big reorganizations in the 1940s and 50s, which lowered their debt payments, most improved their health. The New Haven Railroad was a notable exception, but it barely met the safety criteria to begin with.
And the Penn Central collapse in 1970 must have really driven that point home.
Oh, absolutely. If you look closely, Penn Central's ability to cover its fixed charges was already looking shaky, below conservative levels as early as 1965. Investors paying attention to these metrics had warning signs years before the actual bankruptcy.
What about public utilities? They generally feel more stable.
You're right. For utilities, relying on these past safety tests is probably even more effective. Major bankruptcies of well-capitalized utility companies are incredibly rare, especially since the SEC stepped in and broke up the big holding companies back in the 30s and 40s. The utility failures back then were almost entirely due to crazy financial structures and leverage, things that clear safety tests would have flagged.
Okay, but industrial bonds seem like a different beast, maybe less predictable.
That's a fair point. Yeah. While the industrial sector as a whole has grown earnings faster than railroads or utilities, individual companies can be less stable, less predictable. Historically, the prudent approach was often to stick with the really big, major industrial companies, the ones with a proven record of weathering serious economic downturns. Now, we haven't seen as many industrial bond defaults since, say, 1950. But we also haven't had a truly massive depression in that time. And since the mid-60s, we have seen many industrials take on more debt, sometimes related to expansions that didn't pan out. So while the past is a vital guide, you still need ongoing, careful analysis, especially with industrials.
Okay, that gives us a good handle on analyzing bonds and preferreds for safety. Let's pivot now to common stocks.
Sounds good.
With stocks, it's not just about safety, right? We're trying to figure out if they're a good value. Does the price make sense?
Exactly. The ultimate aim of common stock analysis is to arrive at some estimate of its intrinsic value, what it's really worth. Then you compare that estimated value to the current market price. Is it selling for less than it's worth? If so, it might be an attractive buy.
So how do you get to that intrinsic value? What's the standard approach?
The standard method basically involves two steps. First, you try to estimate the average earnings per share the company is likely to generate in the future, its future earning power.
Okay.
Then second, you multiply that estimated future earning power by an appropriate capitalization factor or multiplier, essentially a PE ratio.
Right, estimating future earnings, that sounds incredibly difficult, like gazing into a crystal ball. How do analysts even start?
Yeah, it's definitely more art than science sometimes. It's tricky. The process usually begins by digging into the company's past. Look at their historical sales volume, the prices they've been able to charge, their profit margins over time. Then analysts build projections. They forecast future revenue based on assumptions: how might volume change? How might prices change compared to the past? These assumptions need to consider the big picture, like forecasts for the overall economy, GDP growth, and so on, but also specifics about the industry and the company's competitive strengths or weaknesses.
And how accurate are these forecasts usually? Because it often feels like predictions are all over the place.
You put your finger on a really crucial point: the uncertainty. Graham actually discussed this using an example from 1965. He looked at earnings forecasts made by the Value Line service. They projected earnings and dividends out a few years and used a formula to estimate a future stock price range. When they looked back at forecasts made in mid-1964 for the 1967-69 period and compared them to what actually happened in 1968.
What did they find?
Well, the combined forecasts for groups of companies turned out to be reasonably close. But the forecasts for many individual companies were way off.
Ah, interesting.
It really highlights something important. Predicting the average outcome for a group is often more reliable than trying to pinpoint the exact future for one specific company.
Yeah, that makes intuitive sense, like forecasting the weather for a whole region versus a single street corner.
Exactly like that. Now, ideally, sure, you'd want to just invest in the few companies whose futures you feel you understand perfectly. But the real challenge is reliably knowing in advance which of your individual company predictions will actually be right.
Right.
And that inherent difficulty, that uncertainty, is a major reason why most investment funds diversify. They spread their bets across many different stocks. Concentrating everything in one stock could theoretically give the best return if you pick the absolute winner, but the risk of being wrong is high. Diversification is a practical way to manage that risk.
So even though everyone talks about stock picking, diversification is kind of an admission that predicting the future for individual companies is really hard.
That's a good way to put it. It acknowledges the challenge. Okay, so we estimate future earnings, then we need that second piece.
Yeah.
The capitalization factor, the multiplier.
Right, the PE ratio, essentially.
Yeah.
Why are investors willing to pay, say, 20 times earnings for one company, but maybe only 10 times for another, even if they expect similar earnings next year? What drives that difference?
Great question. That multiplier, or capitalization rate, can vary hugely, even for companies with the same expected earnings per share. It really comes down to the perceived quality of the stock and its future prospects. Several factors play into this. First is the general long-term outlook for the company and its industry. Now, nobody truly knows the future, but the stock market is constantly trying to guess. The PE ratio reflects the market's collective opinion about future potential. Graham gave an example from 1963. Chemical companies in the Dow Jones Index were trading at much higher PE multiples than oil companies. The market was more optimistic about chemicals.
And how did that turn out?
Well, interestingly, over the next few years, the chemical companies' earnings didn't actually grow much, while the oil companies did relatively better than their low PE ratios implied. It just shows that market sentiment, often based on extrapolating recent trends, can be unreliable. Just because a sector did well recently doesn't automatically mean it deserves a permanently higher multiple.
So relying too much on past growth to justify a high PE today can be dangerous.
Exactly. Another big factor everyone talks about is management.
Right. Betting on the jockey, not just the horse.
Precisely. But the problem is, how do you objectively measure management skill before it shows up in the results? It's really difficult. Generally, a company with a great track record probably has good management, right? And that's likely already reflected in its past results and maybe in the consensus future earnings estimates.
So you shouldn't necessarily pay an extra premium just for good management on top of that.
Graham cautioned against overemphasizing it as a separate factor, unless there's been a really significant recent change in leadership that hasn't fully impacted the numbers yet. Think of Walter Chrysler turning around Maxwell Motors back in the 20s, or the new team at Chrysler in the early 60s. Those were potentially game-changing shifts.
Okay. What about the company's financial health? Does that affect the multiplier?
Absolutely.
Yeah.
Financial strength and capital structure are key. A company sitting on a pile of cash with very little debt is generally viewed more favorably and might command a higher PE than a company with the same earnings but loaded with debt. All else being equal, of course. Now, having some debt isn't automatically bad. A modest amount can actually create leverage, which can boost shareholder profits when times are good. But leverage is a double-edged sword. It also magnifies losses when things turn sour.
Makes sense. And what about dividends? How do they play into valuation?
Dividends matter in a couple of ways. First, the dividend record. A long, uninterrupted history of paying dividends, say 20 years or more, is a strong positive signal. It suggests stability and financial discipline. For more conservative, defensive investors, this might even be a strict requirement.
Right. A sign of quality.
Exactly. Then there's the current dividend rate, or the payout ratio. Traditionally, established companies often paid out maybe 2/3 of their average earnings, though that's been a bit lower more recently, with high profits and inflation encouraging reinvestment. When the dividend payout is sort of normal relative to earnings, valuing the stock based on its earnings or based on its dividends often leads to similar results.
But what about growth companies that reinvest everything?
Right. That's the big exception. Many fast-growing companies deliberately keep most or all of their earnings to fund expansion. Valuing them based on current dividends doesn't make much sense. We'll actually get into dividend policy more deeply later on.
Okay. So that brings us squarely to those growth stocks, the ones where future potential is the main story, often leading to really high PE ratios. How do we approach valuing them?
Yeah, that's a perennially tricky area. Graham actually proposed a simplified formula specifically for trying to value growth stocks. It's not perfect, but it's a starting point. The formula was value equals current normal earnings multiplied by 8.5 plus 2 times the expected annual growth rate.
So value earnings X, 8.5 plus 2G, where G is the growth rate.
Basically, yes. The 8.5 was seen as a sort of baseline PE for a no-growth company, and then you add a premium based on the expected growth rate over the next, say, 7 to 10 years. It was meant to give results roughly in line with more complicated discounted cash flow models.
That's surprisingly simple. So you need a handle on current normal earnings, smoothing out bumps, and an estimate of that future growth rate.
That's the core idea.
Yeah.
And you can flip the formula around too. If you know the stock's current price and its current normal earnings, you can solve for the G, the growth rate the market is implying or baking into the current price.
Oh, okay.
Using that 1963 example again, a stock like Xerox had a PE ratio that implied a very, very high future growth rate, much higher than, say, General Motors at the time. The market had huge expectations for Xerox.
But what's the risk there if that predicted high growth doesn't actually happen?
Exactly. That's the danger. If a company is priced for, say, 20% annual growth for the next decade, and it only delivers 10%, the stock price could get hammered, even if 10% growth is still pretty good.
Right.
Valuations using this formula for very high growth stocks can seem low if those growth rates are actually achieved. But analysts often build in a margin of safety. They might use a more conservative growth estimate in the formula than the market implies, aiming for a valuation that still looks okay even if growth disappoints somewhat.
So the formula is a framework, but judgment is still key.
Absolutely. Graham himself noted that trying to realistically estimate both the right current earnings multiplier and the right future multiplier for companies expected to grow faster than, say, 8% a year is incredibly difficult. The potential for error is just very high.
Did those 1963 examples work out? Did Xerox grow as expected?
Interestingly, in the case of Xerox and also IBM back then, their actual growth over the following years did come pretty close to those very high rates implied by their 1963 prices, and their stock prices soared.
Wow.
But that's not typical. Many other companies whose stock prices in 1963 implied high growth failed to deliver that growth, and their stocks subsequently underperformed.
So these formulas are illustrative, not predictive guarantees.
Precisely. They help you think about the relationship between price, earnings, and growth expectations.
Yeah.
But they come with huge caveats. Future prices might not follow predictions even if growth targets are met due to changes in market sentiment or interest rates.
Ah, yes, interest rates. You mentioned earlier that a truly rigorous valuation should consider future interest rates. How does that fit in?
That's a critical point, theoretically.
Yeah.
Higher future interest rates make future earnings and dividends less valuable today because investors have better alternative investments available, like bonds. So ideally, your valuation model should discount future cash flows at a rate that reflects expected future interest rates. The massive problem is, who can accurately predict interest rates years into the future?
Yeah, seems impossible, especially lately.
Exactly. The volatility we've seen makes long-term interest rate forecasting incredibly challenging. That's one reason why these older, simpler formulas, like Graham's growth stock formula, persist. Not because they're perfect, but because finding a clearly superior alternative that reliably incorporates future interest rates is just really, really hard.
Okay, that covers a lot on valuation. Let's shift gears slightly and talk about industry analysis. How important is understanding the whole industry a company operates in?
It's definitely important. The overall prospects of an industry is growing, shrinking, facing disruption, clearly had a big impact on the stock prices of companies within it. So security analysts spend a lot of time studying industries, looking at competitive dynamics, trends, regulations, and so on. And sometimes these deep industry studies can uncover really valuable insights, things the market hasn't fully appreciated yet about future trends or challenges. Finding those can give you an edge.
But you mentioned earlier that Graham was a bit skeptical about the value of many publicly available industry reports.
He was, yes. His point was that often, by the time an industry trend is widely discussed in analyst reports, it's probably already well known and reflected in stock prices.
Right. The information edge is gone.
Pretty much.
Yeah.
He noted how rare it was to see Wall Street reports predicting the decline of a popular, beloved industry or arguing for the potential of a deeply unpopular one. Forecasts about long-term industry profitability haven't historically been very accurate.
But surely, with technology changing everything so fast now, understanding industry shifts must be more critical than ever.
You're absolutely right. The pace of technological change has definitely heightened the importance of good industry analysis. A company's future can hinge on how it adapts to new products, new processes, new competitors emerging from unexpected places. This creates real opportunities for analysts who do the hard work field trips, talking to customers and suppliers, really digging into the technology. But there's a trade-off. Investment decisions based heavily on these glimpses of the future without strong support from current financial reality carry higher risk. You might be right and make a lot of money, or you might be wrong or just too early. Being too conservative, only looking at present demonstrable value, might mean missing out on big growth opportunities. It's a constant balancing act.
Which brings us back to the challenge of actually putting a number on a stock's value. Graham suggested an alternative way to think about this, a two-part appraisal process.
Yes, he floated this as a potentially more structured approach than just jumping straight to future projections. Part 1 is calculating a past performance value. This is purely based on the historical record, things like past profitability, earnings stability, growth rates achieved, financial condition. You might even use a formula to weigh these factors and arrive at a value suggesting what the stock would be worth if its past relative performance just continued.
Okay, so a value based entirely on history. What's part 2?
Part 2 is adjusting that past performance value based on your assessment of how future conditions are likely to differ from the past. Graham even imagined a potential division of labor. Maybe a senior analyst develops the historical formula, junior analysts crunch the numbers for lots of companies to get that initial value, and then the senior analyst applies their judgment about the future to adjust that value up or down, clearly explaining why they're making the adjustment.
Interesting idea. Did he think this would lead to better valuations overall?
He acknowledged it might have limits, especially for typical industrial companies where the future can be very different from the past. But he saw potential value. First, it's a more systematic process than what many analysts might do intuitively, so it could potentially improve on current practice. Second, it's great training for analysts. Third, it creates a documented record of valuation judgments and how they turned out, which could help the field learn over time, like in medicine. He specifically suggested public utilities might be a good area for this approach, given their greater predictability compared to many industries.
So the ultimate goal is still finding value, maybe by focusing where the past is a better guide, or where the gap between that past performance value and the current price is really large.
Exactly. Intelligent analysts, he thought, would naturally gravitate towards more predictable groups, or situations where the margin of safety, the difference between calculated value and market price, seemed substantial, even based just on the historical picture. He stressed, though, that truly making independent buy-sell decisions requires deep, systematic study, going beyond just these frameworks.
Okay, now let's bring in Jason Zweig's commentary, which adds a really practical layer to all this. He starts by emphasizing independent thinking.
Right. He quotes Sir John Templeton. If you want to have a better performance than the crowd, you must do things differently from the crowd. That's a classic line, but so true in investing.
To get better results, you can't just follow the herd.
Exactly. Zweig really hammers home that achieving superior results requires discipline and a process that differentiates you. You need to think for yourself and stick to your guns.
And then he introduces this fascinating idea of kind versus wicked learning environments. How does that relate to the stock market?
It's a brilliant analogy. A kind environment gives you immediate, clear, accurate feedback. Like learning chess. You make a bad move, you lose a piece. The feedback is instant and unambiguous.
Okay.
The stock market, Zweig argues, is a wicked learning environment. The feedback, the stock price moving up or down, is often delayed. It's noisy. Prices move for all sorts of reasons unrelated to your initial thesis. And it's ambiguous.
How so?
Well, say you buy a stock and it goes up 20% in a month. Does that mean your analysis was brilliant? Maybe. Or maybe the whole market went up or there was some random news. The price move itself doesn't definitively tell you if your reasoning was sound.
Right. And if it goes down, it doesn't automatically mean you were wrong either.
Precisely. It could be market noise, or maybe your thesis just needs more time to play out. The short-term price action gives very unreliable feedback on the quality of your decision-making process.
So how do we get better, kinder feedback from this wicked market?
Zweig's solution is documentation. Before you buy, write down your entire rationale. Why are you buying this? What specific evidence do you see that the market is missing? What's your valuation based on? What's your expected time frame? How confident are you?
So you create your own feedback loop based on your initial reasoning.
Exactly. Then later, you can go back and compare what actually happened, not just to the price, but to your original thesis.
Yeah.
Did the things you expected to happen actually occur? Did the risks you identified materialize? That gives you much better feedback on your analytical process.
And the key tool for making sure you do this consistently is the checklist, right?
Absolutely crucial. Zweig insists, never buy a stock without first completing your checklist. It forces discipline. It prevents you from acting impulsively based on a hot tip or market excitement. It ensures consistency in your analysis, making sure you don't overlook critical factors. And maybe most importantly, it creates that record, allowing you to systematically learn what works for you and what doesn't.
Now, obviously, everyone's checklist might look a bit different. It should evolve based on your own mistakes and experiences.
Totally. But Zweig provides some core areas it should cover, shifting the focus firmly from the flickering stock price to the underlying business.
What are some of those key areas?
First, really understand the financials. Read at least the last 3 annual reports, the recent quarterly reports. Know the balance sheet, how much debt is there, the income statement, where do profits come from, what are the costs, the cash flow statement, does the business generate cash or consume it? And don't just skim the numbers. Read the narrative sections. Understand the competition, dependency, growth plans, how they allocate capital.
He also stresses reading the proxy statement. Why is that so important? Many people skip it.
It's where you find vital clues about governance and potential conflicts of interest. How much is management paid and how? Are there related party transactions? Excessive perks? Do directors own stock? Are executives buying or selling? Critically, is incentive pay tied to things that build long-term value, like return on equity or book value growth, or just short-term metrics like the stock price or some adjusted earnings figure?
Right. Then there's assessing the moat, the company's competitive advantages.
Yes. Does it have real, durable advantages? A dominant brand?
No.
Patents? A structural cost advantage? Network effects that lock in customers? How hard is it for customers to switch? You need to be tough-minded about this.
And evaluating management quality, trying to spot the difference between real operators building value and maybe promoters just focus on the stock price.
That's key. Do managers deliver on promises? Do they admit mistakes? Is their accounting conservative? Do they talk and act like long-term business owners? Zweig also suggests doing a pre-mortem.
A pre-mortem, what's that?
Imagine it's a year from now, and this investment has been a disaster. Why? Work backward to identify all the potential weaknesses and things that could go wrong before you invest. It forces you to confront the potential downsides.
That's a powerful idea.
Finally, the checklist should make you articulate your edge. Why do you think you understand this better than the market? Estimate your odds of success. Define your time frame. And ask yourself, would you be comfortable owning this business if the stock market closed for 5 years? List the non-price reasons why the business itself should improve over time.
Wow, that is a thorough process.
It is. And Zweig's final unbreakable rule is, if you haven't completed the checklist, you don't buy, period. He also adds a really important point. If all of this sounds like way too much work, like something you just don't have the time or inclination for, that's perfectly okay. It probably just means you're better suited to being a defensive investor, perhaps using index funds or following simpler strategies. There's absolutely no shame in that. Honesty about your own limitations and interests is crucial.
So this whole exploration of security analysis, drawing on Graham's foundational principles and Zweig's practical wisdom, really comes down to thoroughness, independent thought, and discipline, especially in a market that often gives confusing signals.
Exactly. It's about digging deeper than the headlines, building a solid understanding of value and risk for each specific investment.
And maybe a final thought for our listeners is to reflect on their own process. If you invest, do you have a process? Could a checklist help? What are your non-negotiables before putting capital at risk? It's about cultivating that disciplined, independent mindset that Graham and Zweig champion. Thanks for joining us on this deep dive.